Good morning, everyone. This is Marshall Gidler bringing you the morning comment for December 10th. Risk reduction was the name of the game yesterday after the Chinese and Greek equity markets collapsed. The S&P 500 was down 1.3% at one point, and dollar yen fell through some important support lines. However, U.S. stocks managed to recover during the day and closed little changed, which allowed the dollar to recover broadly, although not entirely. This morning, it's opening lower than its early Tuesday levels against most currencies, the main exception being the ruble. It's also noticeable that precious metals didn't reverse along with stocks and the dollar, and the precious metals finished the U.S. day only slightly off their highs. The main impact of yesterday's volatile market was to establish new ranges for several currencies. It's possible now that these ranges may hold during the slow December market, as long as we don't get any more scares. Then again, the thin market as we approach the holidays could mean more volatile conditions. During the Asian day, China's PPI and CPI for November were released, and both were lower than expected, with the PPI further in deflation and the rise in the CPI less than expected. This shows that additional monetary easing has yet to be seen in prices, which suggests that more raising is still possible. This would be supportive for risk and for the dollar. As for today, with no major economic indicators out during the day, I expect the FX markets to follow the lead of European equity markets. It's hard to say how they'll go, however, given the mixed run-up in other markets, U.S. unchanged, China up, Japan and South Korea down. Nor are there any speeches by the senior major ECB officials that would be likely to give Europe a boost, as occurred yesterday. The main indicator of the day is Norwegian CPI. Inflation there is expected to slow slightly on a year-on-year basis. Just a day of the Norges Bank meeting, the low oil prices and expectations of a decline in the inflation rate could prompt a response from the bank to prevent the deterioration of the Norwegian economy. That could be negative for the Norwegian krone. Later in the day, near the close of the U.S. session, the spotlight will be on the Reserve Bank of New Zealand meeting. The bank is universally expected to leave its policy rate unchanged at 3.5%. Governor Graham Wheeler could reiterate the view that the exchange rate has yet to adjust materially to lower commodity prices. Also, some pundits are now predicting that the next rate move in New Zealand will be a cut rather than another hike, as was expected up to now, and the market will be looking for any clues about this. If Governor Wheeler does adopt a dovish stance and moves away from his on-hold stance at the meeting, it could add to further selling pressure on the Kiwi, pushing the Kiwi dollar to even lower levels. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.